Archie, it's already Q4. Is it too late for me to save on my taxes?
Well, Eric, let's distribute some information. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to Last Paycheck. I'm Archie Hoxton, your host. We've got a special guest today, Eric Lewis, certified public accountant. Eric, thanks for being here.
Yeah, thanks for having me. Looking forward to it.
Yeah, we've got an interesting topic today. It's timely, right? We're getting close to the end of the year, and we wanted to talk about taxes and specifically year-end tax planning and what you can be doing as we're in October, approaching November, December, what you can be doing to plan to make sure you're set up for success come next April. So I don't know, to kind of start us off, when I think of year-end tax planning as a financial advisor, first thing that comes to mind for me is required minimum distributions.
Absolutely.
I think maybe we should start by kind of, for people who are new to the show, explaining what RMDs are.
Sure. Sure. I mean, required minimum distributions are exactly as they are described in the background of the acronym there. They are the way that the government gets their taxes on deferred retirement plan assets. So, so if you've got an IRA, if you've got a 401k, the IRS, the Congress doesn't want that to just carry on in perpetuity without anyone paying tax on it.
Right.
So you get to a point and an age in which, generally an age in which they say you've got to start taking some money out and paying tax on it, and there are calculations involved with that that your wealth manager helps you with. To determine how much you need to take out. And you've got to do that by December 31st every year, or there are penalties and ramifications to not doing that.
Right. Yeah. And I mean, if you think about it, you took the deduction on the front end. You've been enjoying this benefit for a long time. The IRS is going to get their cut eventually.
Absolutely.
And right now, the law as it stands is when you turn 73, you have to take it. That's the first year you've got to take it, technically. And it's one of those things that if you do forget about it, I don't know of a steeper penalty in the tax code personally.
Yeah.
It's pretty bad.
Yeah. The good news is IRS understands that that's very punitive. So if you do forget about it, there's a fix. You can request that they waive the penalty if you fix it quickly after year end. I've, knock on wood, I've never seen them not let you get out of that, but they'll probably only let you do it once. So don't forget again.
Yeah.
The key is there, just communicate with your wealth manager, get that thing withdrawn. And you'll get a 1099-R by January 31st of the following year. And that tells a preparer like me how much you took out, whether there were withholdings on it. And then we report that on the return. That's what the IRS is looking for on the return side. Obviously, they match the 1099-R to your 1040. But the RMD is really solely, they're not going to tell you what your RMD is. It's solely the responsibility of the taxpayer and working together with the wealth manager to assure that comes out.
Yeah. And it's a fairly simple calculation. It's just, the end of year balance of the account, right? And it's for all of your IRAs together. But that you take the end of year balance of your IRAs, and the IRS provides a life expectancy factor. It's just a number based on your life expectancy. It's just a simple, you divide it, that's how much you have to take out. So people can calculate it on their own fairly easily if you know where to find the life expectancy table. So for people who this is their first RMD, right? They've just turned 73. There is another kind of leniency in the code that you can actually wait and delay it until April 15th. And that's, again, because the penalty is so steep. If it's December 31st of the year you just turned 73 and your buddy goes, oh, you took your RMD, right? And you're like, what's an RMD? Yeah. In that case, you don't have anything to worry about. The only downside is that next year, when you take the first RMD, you're also going to have to take your second RMD.
Yep. You're doubling up.
Yeah.
It's even, and the other thing that's more complicated too, generally what we've been talking about is folks who own the IRA or the 401k, they're the one who put the money in. But it's a little even more complicated for those RMDs for folks who inherit an IRA or a 401k, because those rules have changed. They're kind of wacky right now. There's some debate as to what you're supposed to be taking when. So, really, if you've inherited an IRA, definitely consult with your wealth manager and your tax advisor.
Definitely.
So you can figure those out, because we may be too deep in the weeds to get into what all those rules are, but it's more complicated. So
there's almost a whole new episode idea right there, actually.
Right.
And that's one where I remember when it was, I guess, Secure 2.0 came out. I was still working at a large company, and everyone at the company was like, wait a minute. What do we tell our clients? Right. What do they need to do? Answer was usually have them talk to their CPA, and the CPA talk to your financial advisor.
Right.
And then finally, I think the IRS came out with some clarification around it, which was helpful. But, but that's something to stay on top of for sure. Right. What about, Eric? So what would you do if someone comes to you and says, I have an RMD, but I really don't like paying taxes. What can I do? Is there anything I can do?
Yeah. I mean, the best way, if they're inclined to give to charity or to their church or to, even their local town, the best way to avoid that is to make a qualified charitable distribution. Because if you don't need the money from your IRA or your 401k distribution or 403b, whatever it is, and if you always do give to charity anyway, then the best way to do it is to make a qualified charitable distribution, because you're sending it directly from your retirement plan to the charity or the church or whoever you're giving to.
Right.
Which the big benefit for that is you don't end up reporting that distribution at all above the line. So your adjusted gross income is lower. And so that reduces your taxable income. For most folks now that the standard deduction after 2018, the standard deduction went way up. So the vast majority of the people, unless they give a considerable amount of money to charity or have a large mortgage, they don't use itemized deductions anyway.
Yeah.
So this is a way for you to get a tax deduction essentially on both the federal and the state, because it lowers your adjusted gross income. Whereas if you're giving your money as a charitable donation, it comes off your federal taxable income, but not your state, because West Virginia doesn't have itemized deductions. If we're talking West Virginia, most states don't. So you're getting the benefit of that, and lowering your taxable income and giving to charity, which you would have done anyway.
Yeah.
So to me, that's the best thing. That's the thing I tell most folks that come to me like that.
Yeah. Well, and it's like you said, for most folks, that's just the best way to give to charity from a tax perspective, because of the size of the standard deduction. Most people aren't itemizing anymore. So it just makes the most sense. And, again, at year end, you got to do it by December 31st, right? So This is tying back to this, like, things to be thinking about right now: taking your RMD, giving directly from your IRA for the qualified charitable distribution. All of this is giving you better control over, if you've got a sense at the end of the year what your income looks like for all the year that's gone by. If your RMD is going to pop you into a higher bracket and you don't like that, well, maybe consider just giving it away. They won't keep any of it in that case, but you're giving to a cause maybe you're passionate about.
Mm-hmm. Yeah, and talk to your financial advisor early about that.
Yeah.
I'll be the one to say this, so you don't have to. Don't call your wealth manager, your financial advisor on December 31st at 10 a.m. and say, hey, I want to make a qualified charitable distribution, because there's paperwork involved. It's going to take a while, so don't do that.
Yeah.
Do that early.
Right.
Do that earlier in the year. Do it in November. Do it in early December, so that you can get all that done in time, so that it happens. And the 1099-R, you meet your RMD requirement, and the 1099-R comes out correct.
Yeah.
Anything
regarding the financial markets, because, in that case, you're probably going to be selling securities. You should assume, do it in advance, right? Because there are certain time frames that are set in stone that you can't get around, that you need to be mindful of. So, that's a great point. Don't procrastinate on that. Right. So what about, another strategy that is often discussed for year-end tax planning is, and we've discussed it in episodes before, but bunching itemized deductions.
Sure.
So as opposed to taking the standard every year. Talk a
Sure,
little
absolutely.
about that.
So as I mentioned a second ago, 2018 tax law changed. They got rid of exemptions. So you don't get an exemption for you and your spouse and your kids that are dependents. They raised the standard deduction way up. So for 2023, it's $27,700 for a married couple. Well, you're capped on your state and local at $10,000. So your state income tax, your real estate you pay on your real estate tax you pay on your house, your tax you pay on your car, that's capped at $10,000. That's called the SALT deduction. You probably make too much to deduct your medical expenses because of the threshold there. You may not have a mortgage anymore, right? So you're not getting that. So now you're at a point where your only itemized deduction may be $10,000 of state and local, and you've got a $27,700 standard deduction. So one strategy is, if I'm going to give to charity, I'm going to do it all in 23, or do a lot of it in 23, so I can get up above the 27.7, get as many dollars to count as a deduction as possible. And then I maybe don't do it in 2024, so I take advantage of the standard. So it depends on how much you're going to give as to what your benefit's going to be. But it can be a way, whereas if you gave, if you had a $10,000 SALT deduction, no mortgage, and you gave $13,000 away in 2023, you're going to get no tax benefit from that because now you're under the standard. If you do the same thing in 2024, you're going to get no benefit. But if you have the money and you give $26,000 in 23, then you're going to get a benefit from it that you wouldn't have gotten if you just did your normal increment.
Yeah, that's a great point. And that's where thinking about your taxes, moving from I'm just April 15th to April 15th, you're thinking multiple years in advance and developing a longer term strategy for managing your tax burden.
Absolutely.
And that's huge. And I think that that's something that, not everybody thinks about. And especially at the end of the year, if you're at year-end tax planning because you just kind of waited until the end of the year, that might not be something that's possible. But if you're someone who likes to think in advance and wants a multi-year tax strategy, that's a great one.
And communicate with your preparer.
Yeah.
Your tax preparer, we all have folks who we hear from on March 1st. We get all their stuff. I always tell people I would much rather we fix something in August than wish we did in March, right? Yeah. So communicate with your preparer because they can work with you on this type of thing. There are thousands of great tax preparers, CPAs, enrolled agents around the country that proactively think like this.
Yeah,
they can't help you if you don't talk to them until you drop your stuff off or upload it to their portal in March.
Right.
Or they really can't help you if you don't even do that and you get an extension filed and you don't upload it until September, right? So that's the key. Communicate with your preparer. The really good ones welcome that and want to have that dialogue and want to be tackling these things when you can do them, when you can fix them. Because after year end, there's very little you can do after year end for the year prior.
Exactly. Yeah, and that's really, really important. And I love it when my clients, come to me for specific advice. That's something that most really great CPAs are also open to. What can I be doing? It may be that you're doing everything you need to be doing, but maybe there's something you're not thinking about. So, but do that before tax season because it's really busy. Again,
well, you can't. Proactive. Yeah, during tax season you can't fix it for 2023.
Yeah,
if you wait till March of 2024, generally, and they're so busy that they don't have really the time to give you the advice for 24 at that point.
Yeah.
So the best time to talk to your tax preparer this summer is November. That's a great time to talk to your tax preparer because we're past the October 15, 16 deadline and we go into a little bit of year-end planning mode. That's a really good time to reach out.
Definitely. What about, and I think we've got enough time for maybe a quick touch on one last piece that's that another one that you said you get lots of questions about, but it gifting, not necessarily charitable giving, but giving to a friend or a family member.
Sure.
So when it comes to planning that out, what most people don't realize is that they hear about gift tax, but it's a complicated system. It's not, I give you $20 and I pay tax on it. There are exclusions, right? You can give up to a certain amount. I believe for 23, it's 17,000 if you're a single person. If you are married and you do gift splitting, it's 34,000. You can give that without paying taxes. Talk a little bit about how maybe situations you've seen or how someone might plan at the end of the year to do their giving to people.
One of the biggest misconceptions we run across with taxpayers is the term gift tax. They think that if they give money to someone, there's a tax, or the recipient pays a tax.
Yeah.
There's almost no gift tax paid in the United States every year.
Yeah.
Because the exclusion is so high.
Right.
So, yes, you're right. 17,000 for 2023, 34,000 for a married couple. Any individual can give any other individual up to $17,000 a year and not report it anywhere.
Yeah.
No return is filed. Nothing happens. You just gave them $16,500 or $17,000. And for any reason you want, there's no return filed. If you give more than that to any individual, a gift tax return is required. But again, there's not going to be any gift tax paid under the current structure because the annual exclusion, the lifetime exclusion, for an individual is almost $13 million. So all you're doing if you give someone more than $17,000 is you're telling the IRS, hey, I gave more than 17, so take that difference and knock it off my 13 million.
Yeah.
Right? I think the gift tax applies, or the estate tax applies to like 1,000 estates or gifts a year in the country out of 350 million people. So it's a very small number. So one thing that you can do though is if you are planning on giving your kid, money for a down payment on your house, let's say you're a married couple, your child wants to buy a house, needs $50,000, right? One of the ways you can just avoid a lot of paperwork is give some of it in December of 23 and some of it in January of 24.
Right.
So your total gift is under 17,000 each for each of you and your spouse. And there's no paperwork involved. You don't even have to bother anybody to file a gift tax return.
Yeah.
That's one way to do it. If you did decide to give them more, the gift tax return is a hassle. It's going to cost you to have someone prepare it. But at the end of the day, you're not going to pay a gift tax on it.
Right. You're just chipping away.
You're chipping away.
If you're someone in that, bundle of 1,000 transfers that qualify, that people pay tax on, then it's important, right?
Yep.
If your estate is going to be, 26 million or more, 27 million or more, then you might have some strategy.
Right.
And then maybe taking advantage of that giving every year up to the exclusion.
Yep.
Annual exclusion is a part of your strategy.
And it also gets further complicated, in 2026, when this law that increased the lifetime exclusion sunsets and it drops back down to 5 to 7 million, then we have to think about that too, right? So, for 23, 24, 25, we've still got these really big numbers happening, assuming you don't pass away, in 2026 when it drops back down or Congress doesn't change it, you're still kind of for most folks, it's kind of a moot point.
Yeah. But, and that changes a lot. I mean, it changed it became really high around the 2018 laws, I think. And then, but it wasn't long ago that there was less than $1 million.
Less than $1 million.
Yeah.
Right. And then there was a year in which there was no estate tax at all. I think it was the year George Steinbrenner died. It happened to be the year there was no estate tax at all. So that was a weird little scenarios you got to keep your eye on.
Yeah.
And that's what you're working with your financial advisor, your CPA.
Maybe
hopefully you've got an attorney.
Yeah.
Right, exactly. You've got an attorney working on your estate. Yep.
Yeah, definitely. Well, hey, that's about it for today. We've got part 2 coming next, so stay tuned. There's a lot more to talk about with year-end tax planning, but we hope this was valuable and enjoyable. Remember to like, share, subscribe, turn on notifications, and we'll see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.